Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Big banks beat again. UBS and Santander smash estimates for net income. We'll bring you all the analysis. And as Donald Trump eases tariffs on US automakers, two of Europe's biggest car companies report. We'll bring you those numbers from Volkswagen and Mercedes. Plus, the US president marks 100 days in office with a rally defending tariffs and doubling down on his criticism of the Fed chair, Jerome Powell. Well, a very good morning. We kick off the show with breaking earnings out of Germany. Mercedes reporting that it's withdrawing guidance because of Donald Trump's auto tariffs. It says that the tariff volatility is just too high to provide a reliable outlook at this point. But looking at first quarter sales, they've come in at 33.22 billion euros. The estimate was for 34.37 billion euros. So a miss there. On adjusted EBIT for the first quarter, 2.55 billion euros. A miss again. The estimate was for 2.66 billion euros. So we keep an eye on those earnings out of Mercedes. We watch the shares as they trade at the open. But remember, we already had yesterday Volvo withdrawing its guidance for this year and next. Porsche cutting its annual forecasts for the second time this year, both citing tariffs. So the trade war very much a theme of these earnings out of autos this earnings season, and we'll get VW earnings later in the show. We also have earnings out of France in terms of French banking, Crédit Agricole as well. So first quarter net income, actually a miss here, 1.82 billion euros. The estimate was for 1.85 billion euros. So a contrast there to UBS and Santander. They are looking at first quarter revenue of 7.26 billion euros. The estimate was for 7.3 billion euros. So a miss there as well. The expectation had been that growth in asset gathering was going to offset the slowdown in international retail banking. The shares up 30% year to date. So disappointment out of Crédit Agricole. Staying with banks, we are going to be speaking to the Deputy CEO of Crédit Agricole later this morning. That interview at 7:30 a.m. UK time on the opening trade, so not one that you're going to want to miss. But we've had, as I say, a slew of bank earnings already out this morning. UBS Markets Division posting a record performance as geopolitical turmoil spurs volatility that the bank says is set to continue. We can analyse it now with Bloomberg's Charlie Wells. He joins me around the desk. Charlie, what have been your key takeaways out of these earnings this morning?
Yeah, so really key here is UBS. You know, they had that beat on top and bottom line. And I think what a lot of investors had been wanting to know about was about share buybacks, about this capital return. Because one of the reasons why UBS has been underperforming a lot of its European peers, at least in the markets, has been this concern about capital requirements, about regulation in Switzerland. And it's notable that the bank is saying it is their intention to execute on the entirety of their 2025 capital return ambition. So that's going to come as something of a relief to investors.
And Santander as well, beating on net income, but disappointment, it seems, from Crédit Agricole.
Yeah, so I think on the Santander front, you know, this is a bank that has a huge presence, not just in Europe, but also in Latin America, in North America as well. And I think one of the key questions we're going to listen out for as they start to kind of talk about these earnings is that euro strength, right? Does net interest income come under pressure, at least in the quarter ahead, because of the strength of the euro and because of a potentially more difficult rate environment for them? So I think this beat for the prior quarter, great, but I think we're really kind of focusing on that quarter ahead.
OK, Bloomberg's Charlie Wells, we thank you for that analysis. And we're going to bring you interviews with some of the big names in banking throughout the morning. Don't miss those conversations. We also have the UBS CEO, Sergio Ermotti, the CFO of Santander, and as I say, Crédit Agricole's Deputy CEO. So it's a busy day for earnings, not just here in Europe, but stateside as well. We've had disappointing results from Supermicro Computer, already weighing on US futures ahead of numbers from Meta and Microsoft on the West Coast. But checking in on these broader markets, we've got European futures flat, FTSE 100 futures flat to the downside, S&P E-minis and Nasdaq futures both in the red. And if we flip over to the cross-asset picture, you've got the 10-year US Treasury yield steady now at 4.16%. ahead of the key US PCE inflation data, of course, and growth data as well later in the day. Just checking on euro dollar, 113 is where we are at the moment, so weaker 0.1%. But do keep an eye on that number, because later in the hour we're going to bring you French GDP. That's at 6:30 a.m. London time. Meanwhile, we've got gold weaker again by 0.25%. We had Donald Trump easing some of the trade tensions, at least for autos, and it seems we're in this consolidation period for the yellow metal, the sort you do tend to see after big surges, the likes of which we have seen, of course, in recent weeks. Gold touching that record $3,500 a troy ounce. And the big picture, though, really is the uncertainty. So oil, you can see, headed for its worst April on record. Brent now trading at $63.50 a barrel. We had those China PMIs earlier this morning showing factory activity its worst, contraction since December 2023, a sign perhaps of the early damage from Donald Trump's trade war. But just look here. It's not done too much to move Asian markets. So the offshore yuan had edged lower after that China data. It's pretty steady now. Yes, China has been underperforming Asian equities more broadly. The MSCI Asia Pacific Index up 0.4%. But we're pretty much in the green there. China unchanged on the CSI 300. And really those hopes of a US-Japan preliminary trade deal perhaps adding to optimism on the Nikkei, which is up, as you can see, 0.25%. But really the focus on that US-China deal hanging over the region, really. Just in terms of what else we've got on today, lots on the docket to bring you. We have European CPI and GDP numbers coming out, feeding into the decision about whether to cut in June for the European Central Bank. Markets pricing a 62 basis points of cuts by the end of this year. Then later on today, out of the US, we get GDP and core PCE numbers. On the GDP front, economists expecting a sharp deceleration in growth because of Donald Trump's trade deficit and consumers rushing to get goods ahead of his tariffs. And then, as I say, we have more tech earnings, Microsoft and Meta also on the docket. But you can get yourself ready for all of that. Do go to the Daybreak newsletter by visiting DAYB Go on your terminal. Today, they're focusing on Donald Trump again, bashing Jay Powell, the Fed chair, and touting tariff easing at his rally to mark those 100 days in office. Yesterday in Michigan, you've got US futures dragged by those super micro results, and Mobius saying that his funds hold 95% in cash. We might bring you a bit of that interview later, but really a sign of just the uncertainty in these markets. But let's dive back into the politics here. US President Donald Trump marking 100 days of his second term by again criticising the Fed chair Jerome Powell and touting his economic policies. Trump also signalled orders to ease tariffs on the autos industry just hours before a rally in America's car-making centre, Michigan.
And to help these automakers bring their factories home as rapidly as possible, I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the U.S. In other words, if they can't make it in time because they have to do it here, otherwise they haven't, I'm giving them a little bit of a break.
But Trump later told ABC News that he believes China deserves the steep tariffs he'd imposed on their exports.
China probably will eat those tariffs, but at 145, they basically can't do much business with the United States. And they were making from us $1 trillion a year. They were ripping us off like nobody's ever ripped us off.
For analysis, let's bring in Gesine Weber, who is Geostrategy Team Fellow at the German Marshall Fund. Really good to have you with me, Gesine. You heard there, the President cutting autos a break, but going back to the tough talk on China and the Fed as well. I wonder, after this first 100 days of the second Trump administration, what's the rest of the world meant to make of how to deal with Donald Trump?
So overall, I think that these first 100 days have really shown that US politics and US foreign policy is becoming extremely transactional on the one side, meaning that trade balances count a lot, meaning that your economic ties with the United States count a lot, and meaning that tariffs play a critical role in US foreign policy. But overall also that US foreign policy is becoming much more unpredictable, and also that we currently see a United States that is looking for primacy in the international system, but not necessarily willing to pay the price for that.
But isn't the fundamental issue for Europe that Trump wants to deal bilaterally with strong men, and Europe can't even seem to agree with itself, let alone move quickly enough to deal with the Trump administration?
Yes, exactly. So these are two key problems for Europe. First, there is really this willingness to pursue bilateral ties. And we have also seen during the first Trump administration that the European Union itself was never really an interlocutor because it just is an international organization. And that is not how Trump usually does business with his foreign policy counterparts. And also the ties that he has established with European leaders bilaterally are arguably much more stable than the ties he has with Ursula von der Leyen.
Well, if we take the issue of Ukraine, there was that incredible image, wasn't there, from the Pope's funeral of Donald Trump sitting down with Volodymyr Zelensky. I mean, after this first 100 days, do you conclude that Trump's pressure has yielded anything in terms of peace in Ukraine?
At the moment, the results of that still remain to be seen. So we see that, of course, ending the war in Ukraine was clearly a priority of these 100 first days of the Trump administration. We've seen a lot of exchanges between high-ranking officials, between Trump himself, and even saw him also on a phone call with Russian President Vladimir Putin. So we see that there is a willingness to engage in this peacemaking process. But we also see that the results of that for the moment remain very limited or rather absent. And that basically there is no ceasefire at the moment, although this was, I think, the key element or the key objective of what he wanted to achieve.
But how seriously do you take the threat that the US could walk away from these peace talks? Do you see that happening in the coming weeks, perhaps?
I'm not sure whether it is going to happen in the coming weeks, given that ending the war in Ukraine was also something that was pretty central in Donald Trump's campaign. And if he just walked away now, meaning that basically he has not achieved what he promised and there is no ceasefire and the war is still going on, that would not look like a good result after his first 100 days. I think there is a chance that if there is no breakthrough in the negotiations in the next weeks, this might happen. But on the very short term, I still see the willingness to make an effort to conclude a deal, although for Ukraine this can also imply being pushed into a deal that is actually a very bad deal for Ukraine.
Well, yeah, I wonder what concessions you see as necessary to get this peace, because you've got Russia reportedly pushing to control 4 regions of Ukraine that it doesn't even occupy at this point. Do you think that that's something that Trump will force Zelensky to accept?
That is extremely hard to say what exactly he is going to ask Zelensky to accept. I think there is a high possibility that Ukraine might have to accept not having control over the territories that have already been recognized by Russia or claimed by Russia as Russian territory in an early phase of the war, and the same holds true for Crimea. I think that this is a relatively likely scenario. So Ukraine will now have to brace for reflections on how it can best secure the territory of Ukraine, where it still holds full control.
OK. Gesine Weber from the German Marshall Fund, we thank you for all of your analysis there. Transactional, unpredictable. That's how she describes the first 100 days of this Trump presidency. Dominated by trade policy, and that will be the subject of our next conversation. DHL Group beating first quarter estimates, but tariff tensions really hanging over the logistics giant. We'll speak to the CEO, Tobias Meyer, next. So stay with us. This is Bloomberg. back to Bloomberg Daybreak Europe. You're joining us on a very busy day for earnings. DHL reporting revenue and EBIT for the first quarter beating average estimates. You're looking at first quarter EBIT of 1.37 billion euros. The estimate was for 1.33 billion euros. Also a beat on first quarter revenue. 20.81 billion euros is what it came in at. The estimate was for 20.75 billion euros. So really interesting to look at whether this performance is sustainable later in the year. We've already heard from the likes of Mercedes saying that the tariff volatility is just too high to provide a reliable outlook. That's in the auto space. In banking, we've had Crédit Agricole missing when it came to first quarter net income, in contrast to the likes of UBS and Santander, who we've also heard from this morning. So when we look at the broader picture for futures in Europe, Euro Stoxx 50 futures are flat to the downside, down about 0.1%. Less bad when it comes to FTSE 100 futures, though there's not much in it really between them. DAX futures actually pointing higher, and stateside a lot more weakness it seems to come. S&P E-minis down 0.5%. But I want to dive into these DHL earnings because they really are at the coalface of this trade war, and we can speak now to Tobias Meyer, who is joining me now, the DHL Group CEO. Really good to speak to you, Tobias. Thank you so much for joining us. I wonder, is this performance in the first quarter, your beat on EBIT, a sustainable one throughout the year, given all of the uncertainty that lies ahead?
Yeah, good morning, Lizzie. Yes, we would say so. We had a good start into the year, light growth in revenue, light growth in earnings. It was a quarter that was operationally quite challenging, but financially actually quite a normal one. We continue to execute on our strategic growth initiatives. As you know, we want to really be the experts in life science logistics globally as well. We did M&A in this area also. So, yes, it's operationally challenging, but we're off to a good start, and we delivered also good quality for our customers.
I mentioned before Mercedes saying that they just can't give a reliable outlook at this point because of the volatility. I wonder if you can. And really, when you look at businesses' supply chains, because you're up close to them, is it obvious to you that the US economy is heading for a recession? So we obviously don't know what's going to come in the course of the year, how US trade policy, which is quite relevant for our business as well. 25% of global trade is related to the US, 14% on imports, 11% on exports, roughly. So it is a relevant size of the market, but it's not the complete market. Now, for our business, there are also those concerns that investors have, that others in the industry have. The elasticity of demand to price could weigh down on volumes, particularly on the Trans-Pacific. We also see some negative spill over to consumer sentiment, to investment sentiment. But for us, Lizzie, what's also important is the preponing of inventory, these temporary shifts that creates complexity, that drives volume to higher yielding modes. And we also see the reconfiguration of supply chains becoming longer, new countries, more diversified, more complex. And that's not bad for DHL. OK, well, let's just break down some of these elements of Donald Trump's tariff policy if we can. I mean, how does the end of the de minimis exemption affect your business specifically?
That's yet to be seen how it's exactly executed. The fine print matters, and we have seen this twice now when the de minimis was discontinued. That led for the entire industry, for U.S. airports in particular, to quite some chaos on February. And then we had a change, an unintended change from our point of view, in the way the formal versus informal clearance is defined. Something that the average layman never really deals with. But for us, it makes a big difference because for a formal clearance into the United States, you need additional data items. And this is now also the question as it relates to the de minimis. Will there be new forms? For instance, the importation as break bulk, so many small shipments bundled on one manifest, one clearance, whether that's going to be accepted, under which conditions by customs. So those are the specifics that need to be worked through.
And what about the autos tariffs? We've seen some concessions from Trump overnight. How does that impact your business?
Well, generally, we're a strong believer in free trade, the benefits that it brings. It has helped nations to become more wealthy. It helps to spread the use of technology. Not every nation is able to develop a new medical device, a new pharmaceutical drug. So trade is needed, and trade is improving the livelihood of people. So barriers are a concern. But we also have to see that trade is resilient, and that's what we see these days. We see shifts in Asia to new countries of production. We see different ways of importation, and also the U.S. administration trying to keep the country open as it relates to those operational barriers. How that plays out over the year is to be seen.
But just on that point, do you expect the European market's going to be flooded with cheap Chinese goods to circumvent their own 145% tariffs? Is that something that your business is braced for?
Well, we will see some shifts, but we also see shifts that are a bit more complicated. And I think we have to just face it. The U.S. consumer will also want to continue to buy certain goods. I talked to a white goods manufacturer, for instance. How many white goods are really made in the U.S., and who's investing in factories now to build air conditioning, build washing machines there? So currently there is a need for importation, undoubtedly. So the question is, where are those goods manufactured? So we do see that Chinese manufacturers use the Chinese output to serve other markets, the Middle East, for instance, but they use their Middle Eastern factories to serve the U.S. market. So this is a change. Those type of changes we're going to see more often going forward if those tariffs stay in place.
Tobias, Meyer, thank you so much for joining me, the DHL Group CEO. Really good to get your outlook. Plenty more coming up on the programme. This is Bloomberg. Now to some other stories making news around the world. US President Donald Trump and Canada's re-elected Prime Minister Mark Carney have spoken and agreed to meet in person in the near future. The Canadian PM's office says the two agreed on the importance of Canada and the United States working together as independent sovereign nations. Carney's Liberal Party is on course to fall short of an overall majority in the House of Commons. Elsewhere in Europe, Spain's power grid operator says that a series of disruptions over a few seconds triggered Monday's widespread blackout, which spilled over into Portugal. However, Red Electrica says that it still doesn't have a complete explanation. The Spanish government is not ruling out a cyber attack, although the grid operator denies any hacking. The Prime Minister, Pedro Sanchez, has rejected opposition claims that expanded wind and solar generation were to blame. Those are a couple of our top stories coming up on the programme. With European earnings season still in full swing, we're going to get the view from Viki Farmaki of State Street Global Advisors on the banking sector and how it's doing here compared to the US. So that's next. This is Bloomberg. A very good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Big banks beat again. UBS and Santander smash estimates for net income. We'll bring you all the analysis. And as Donald Trump eases tariffs on US automakers, Mercedes warns that trade uncertainty is just too high for a reliable outlook. We'll bring you Volkswagen numbers as they break. Plus, the US president marks 100 days in office with a rally defending tariffs and doubling down on criticism of the Fed chair, Jerome Powell. Well, we have just got breaking across the terminal the latest GDP numbers out of France. The expectation was for 0.1%, and indeed that is what we have. This is the preliminary reading. It is up from the previous quarter of negative 0.1%. You have, of course, had this reduction in political uncertainty. That replaced, though, by tariff uncertainty, so that weighing on French growth as it is expected to ahead. But a positive reading here, pretty much stagnation though. which combined with tempering Eurozone inflation maybe paves the way ahead for a June cut from the ECB. That's certainly been on the lips of lots of ECB speakers of late. Euro dollar barely budging off the back of this, weaker 0.1% at a 113 handle. Let's check in on these broader markets now. We have futures pointing lower on both sides of the Atlantic, more so stateside though, as we head towards the tech earnings in focus later today from Microsoft and Meta, but already we've had disappointing numbers from Supermicro Computer. On the tariff front, yes, President Trump's cut the autos industry a bit of slack. He's also, though, as I say, talking tough on China and the Fed again. So that pessimism is perhaps what you're seeing on the screen there. A lot of red at the moment. So let's flip over to the cross-asset picture. You've got the 10-year US Treasury yield down a basis point actually at this point at 4.16%. But we still have to look for that key US inflation and growth data later on today. As I say, euro dollar barely changed by that France first quarter GDP number that we've just had. But interestingly, gold weaker again, 0.2% down at $3,312 a troy ounce. It seems like we're in this consolidation phase for the yellow metal, the sort that you seem to see after big surges. But the big picture really is the uncertainty continuing. And we have oil there at $63 a barrel on Brent, headed for its worst April on record after those disappointing China PMIs showing factory activity its worst contraction since December 2023. So a sign of the early damage from Donald Trump's trade war, which really the car sector is at the very heart of. So let's go now to the VW earnings breaking across the terminal. And we have from VW first quarter operating profit coming in at 2.87 billion euros. The estimate was for 3.48 billion euros. So a big miss there when it comes to Volkswagen. And we can get analysis straight from Germany now from Bloomberg's Oliver Crook. He joins us from Berlin. Ollie, why the big miss?
Yeah, Lizzie, listen, we're just waiting for these numbers with sort of anticipation. And for the auto sector, the question is not whether it's going to be good or bad. It's just how bad and how bad is it going to get. So let's look at these numbers we got here out of Volkswagen. So top line revenue managed to grow about 3%. They did manage to sell more cars this quarter than they did a year ago by about 1 percentage point. If you break down to the different regions, this is where things begin to get interesting, Lizzie. Europe was up 4%. South America up 17%. But then when you go to those key markets for Volkswagen, increasingly the United States and China, North America is down 2%. China is down 6%. When you look at the operating profit, that is down almost 40% from a year ago. And of course, what we watch very sort of keenly within the car industry is these margins, the margin figures. The margin figure for this year is at 3.7%. That is materially down from the 6% that we got last year. And that is also missing the estimates that analysts were looking at. In terms of the outlook, this is the key, Lizzie. What are we going to get from Volkswagen? Basically, what Volkswagen has said is that they're not going to change their outlook, but that outlook does not take into consideration any of the tariffs that have been announced, which as far as I'm concerned is effectively a withdrawal of the outlook. So again, bad news here out of the auto sector. You see that the margins and operating profit being eroded, and basically the outlook is unpredictable.
So effectively the same position that we've seen from Mercedes this morning, Ollie. They officially withdrew their guidance because of Trump's auto tariffs.
Yeah, absolutely. Let's break down the numbers and then look into the outlook and see what we could possibly say about what this business can anticipate going into the year. If you look at the earnings across the board for Mercedes, revenue down 7%, earnings before interest and taxes down 40%, net profit is down 42%, free cash flow up 5%, but then you go earnings per share down 40%. This is the picture for the auto sector looking at the first quarter, and this is not even taking into account what is going to come when we look into the future. When we look at their margins, again, for Mercedes-Benz, a luxury car maker, you really need to preserve that margin. That is a top priority. When you look at a year ago, is at 9%. Now we're down at 7.3%, which we should say is a little bit better than what we had been anticipating when we look at what the analysts had been expecting. But when we look into the outlook, again, Lizzie, this is what we got from the statement. This is pretty remarkable. These car companies basically saying we have no idea how to anticipate what is coming for the next years. Material impacts are expected. The current volatility with regard to tariff policies, mitigation measures, and resulting potential potential direct and indirect effects, in particular on customer behavior and demand, is too high to reliably assess the business development for the remainder of the year. And Lizzie, the point that they're making here is actually twofold, because of course these European car makers are on the front lines of these tariffs, 25%. That is absolutely mammoth. But this is the car industry. This is a cyclical industry. They're also riding the macro waves of the global economy. If you get a recession, they're getting hit not just by the tariffs, but global demand completely deteriorating. That is what Mercedes-Benz is flagging this morning.
OK, Bloomberg's Oliver Crook with the latest on the autos earnings. We thank you. And despite that, we are looking at DAX futures pointing higher, set to outperform the rest of Europe at the market open. So we're in the thick of earnings season. We've had autos. Let's turn back to banks now. UBS reporting first quarter net income well ahead of estimates, aided by a surge from trading driven by equities and forex. Now, SocGen and Santander also beat forecasts this morning. And for more on the sector as a whole, we can speak now to Viki Farmaki, who is Senior Analyst over at State Street Global Advisors. Lovely to have you with me, Viki. We've seen lots of banks talking about how they've benefited from volatility in the first quarter. And interestingly, we had a conversation with the Goldman CEO, David Solomon, on this volatility. Here's what he had to say.
If the level of uncertainty grows from here, yes, you won't see the same amount of capital markets activity. But my own belief is things will settle down. We'll have a clearer policy perspective and some normalization of capital markets as we shift into 25 and 26. Even if we have a slower economy, or even far worse, we have a recession, ultimately, when the market adjusts to that and resets, people need to transact, they need to raise capital, they need liquidity for their investments. And so part of this is just a reset of expectations.
All right, so Viki, if we're about to get normalisation, is all of the performance that we've seen in the first quarter about to die down and things get worse for European banking?
I think if we get some clarity, that actually will be quite good news for the banks. So far in Q1, we've seen similar trends to the US banks. And volatility has been good volatility. It has helped the trading activity outperform, and we've seen it from a number of names yesterday and today. But going forward, if we do see some clarity, if we get volatility down, there is a huge pipeline coming through. Corporates are in a wait-and-see mode, and I think once we get some clarity, we'll be able to have some of the other businesses within investment banks, such as M&A, equity capital markets coming through. So that could be positive news for the banks. But so far in Q1, we've had a very good earnings season.
But, I mean, how exposed are European banks to the second-round effects of this trade war? You know, is that risk being underestimated?
Sure. I mean, so far the direct impact is limited for the banks. But as you say, the second round impact is the one to watch for. And that is very macro dependent. And banks are very macro sensitive. So you're absolutely right. This is something on the radar. But so far what we've seen from management guidance is it hasn't changed for 2025. So even with the volatility, they're still guiding to the same return targets. We've seen some downside scenarios presented yesterday. And we saw very small single-digit revenue declines on the back of that. So I think management teams are managing the situation. They're keeping their guidance, which is very important. And also they're going to this environment of volatility with very strong balance sheets and very strong capital levels. We've seen buybacks, even some improvements on buybacks coming through. So I think that the backdrop is positive for them in terms of their own fundamentals.
Well, of course, it's not just in banking. All CEOs at this point don't want to be more pessimistic than they need to be till we've got more clarity. We just have to wonder if it's realistic, right? I mean, one of the macro factors is this German fiscal boost. But I'm kind of wondering, is there a danger that that's more narrative than a real near-term earnings catalyst?
You're absolutely right. The tariff discussions are very short-term. They will be coming quite soon, whereas the fiscal and structural changes to Germany will take place over time. But the sentiment is already improving. There has been a shift in corporate sentiment of what could come. So I think that is helping offset sort of the immediate impacts we're seeing from the trade discussions.
Just when we look at the UK, you know, the narrative is kind of resilience, right? Is that narrative being overstated?
I think we have to wait and see the macro data. As I said, banks are very macro sensitive, and we have to see how that comes through. But banks are using their own levers to prepare for this. The net interest income is supported by the hedges the banks have put in place. So they're preparing for lower interest rates and for the environment that's coming through. They have built their balance sheets with strong liquidity and strong capital levels. So they're managing what they can from their own perspective, and they're pulling the levers they can. And we've seen cost control really come through in these earnings results. And I think that will continue if we see some top-line pressures.
Of course, we'll have to see how much rates can come down if that inflation is sticky here in the UK. But Viki Farmaki, Senior Analyst at State Street Global Advisors, we thank you for joining this morning. Now, coming up on the programme, Equinor's profit slides on weakening oil trading and lower gas prices. We're going to speak to the Norwegian energy giant's CEO next. This is Bloomberg. Equinor's first quarter profit has fallen from a year earlier, missing estimates amid weaker oil trading, lower gas prices and a prolonged outage in northern Norway. We can speak now to Equinor's CEO, Anders Opedal. Anders, good morning. Thank you for joining me. It doesn't seem like a positive read on these earnings, but you're feeling optimistic. Why?
Well, actually, the results are quite good. We have seen higher gas prices this quarter than the first quarter last year, more than 50% higher. We have been able to have high production, both on oil and gas, particularly on the Norwegian continental shelf. But we also increased our gas production in US, where we have acquired more new fields. And then with higher gas prices also in the US, we have a very, very good and robust results this quarter. 8.6 billion US dollar in adjusted operating results, and 2.6 on net income. So we are pleased, particularly on the core business and the resilience of the core business.
But the price of crude is falling. There's extra supply from OPEC, fallout from the US trade war. Many saying that this is shaping up to be the toughest year since the pandemic, and analysts talking about maybe you needing to scrap projects to deal with the fallout. Are they right?
Well, definitely, in the end of the quarter, and particularly now in the second quarter, we have seen lower oil prices due to the extraordinary uncertainty around tariffs, economic outlook. We see OPEC Plus is bringing back new volumes to the market, and this has put some downward pressure to the oil price. What we are focusing on is to ensure that we have very robust and good production from all our fields, ensuring that we are able to be in the market in a good way, focus on our cost, and also have a capital discipline. And that has enabled us to actually keep the dividend, both the cash dividend and the share buyback, stable this year.
I hear you. You're focused on an increase in production, but there hasn't been a noticeable one yet. And what analysts are saying is, headcount's been rising since 2017. Is there a point at which, and what point is it, that you need to start letting people go?
Well, first of all, some of this increase in headcount is because of the growing business. We are having 2 mega projects being executed in Brazil at the moment. This will come in later this year with production, and also in 2028. Norwegian continental shelf is a mature basin. We need a little bit more people to run the Norwegian continental shelf. At the same time, all the infrastructure is paid for, such that the new barrels comes in with very low break-even and very, very short payback time of 1.5 to 2 years. So we are very, very robust, but we also have a retirement wave coming ahead of us. And we wanted to recruit some new, young, fresh people into the organization, get them trained before people are being retired. And we're missing all this good competence we have built for the last 30, 40 years.
OK. I mean, the Trump administration's put your Empire Wind project on hold. The deadline to appeal is the 15th of June. Are you going to appeal?
Well, first of all, this is a very extraordinary situation. We have all the approvals for the Empire Wind. We got them a year ago after a 4-year-long approval period. Now we will evaluate the option. We will have meetings with the administration to see how we can move this project forward. The project was on track and about to install all the equipment that we have produced for this project.
I mean, how long can the project be delayed? Is it an option to just cut your losses and walk away at this point?
We are in a very critical situation of the project because at the moment we are, engaged starting with all the marine activities. So this is a matter of urgency. So we need to clarify the situation very, very fast. But we will come back to when we have to do it.
Just finally, Eni last week pledged to stick with their shareholder distribution plan. What adjustments is Equinor going to be making, if any?
For the dividend and the share buyback plan, we are sticking to what we have said at the capital market update, making sure that we have a robust production and good operations, such that both the cash dividend and the share buyback can remain the same as we communicated.
Okay. Anders Opedal, CEO of Equinor, we thank you for the latest on the outlook from that key energy business here in Europe. We've got plenty more coming up on the programme, so do stay with us. This is Bloomberg.
At this stage, cash is king. So 95% of my money in the funds are in cash. I think right now we've got to keep cash and be ready to move when the time is right.
Well, there's a bearish signal if ever I heard one. Mark Mobius, chairman of Mobius Emerging Opportunities Fund, there saying cash is king. Now, we've got a busy day ahead of us. Let's take you through what is on the docket. We've got Meta and Microsoft earnings coming out. You can see what to look out for from Meta here. On track for its weakest advertising revenue growth in almost 2 years, which really speaks to the weakness of the US consumer. But if we flip the board over to Microsoft, its cloud unit sales seen coming in at the low end of guidance here because of this slowdown in corporate cloud modernization efforts. But on both fronts, we've got to ask, really, are the earnings estimates too high? The forecast for the Mag 7 profit growth has barely budged since March, but already this season we've seen, Tesla reporting its worst quarter in years last week, Alphabet beating expectations but not offering a lot of guidance on the outlook ahead, as we've seen from some of the companies that we've heard from just this morning. So the focus very much today on the tariff outlook as well as capex too. On the macro front, if we flip the board over, we've got PCE and GDP data coming in later as well. On the GDP front, economists expecting a sharp deceleration in growth linked to this trade deficit, and look at where it is right now, at a record. So all of that coming up for you. But coming up on Bloomberg TV, we're going to be speaking with the UBS CEO, the CFO of Santander, and Crédit Agricole's deputy CEO. Stay with us for those interviews. The opening trade is up next. Anna Critty and Guy will take you to the market open. This is Bloomberg.